Today is May 2nd, and it looks like the beginning of a great year once again in 2026. Semiconductor stocks, power stocks are doing awesome. Memory stocks are having best year ever. So things are looking like they're back on track, similar to last year. Now, today, I want to talk about one company that might actually lose out in the era of AI. It's good to be positive, but we should also pay attention to some of the companies that are losing the market share or who are at risk, because that can teach us a lot about finance as well. So if you guys already know me, I like to talk in stories, help you understand the companies better, help you understand the business model. But today I want to compare this company with something new, a new innovation that is most likely going to take over this company. So this video might be a little bit longer, but stay with me because I think you're going to learn something new today. Now, those of you guys who don't know me, my name is Deepak. I'm a tax code advisor. You can learn more about me by going to taxcodeadvisors.com, or you can, Google around or just go on YouTube and search my channel and take a look at some of the deep dives I have done on some of the other companies. If there's a company that you like, then please put it in the comment and I'll be happy to put my thoughts out there on that company. If you want to join my WhatsApp group, which is absolutely free, reach out to me. I'll be happy to add you there. If you want to come see me in person, then come to one of my meetups. I have one coming up in Austin, Texas. So that's going to be on May 16th. It's going to be from 9 a.m. to 3 p.m. So we'll have 6 hours. I'll have a breakfast for you. We will have lunch together. Don't worry, I got you covered. So you don't have to spend any money. I don't charge you big fees to join the event. None of that stuff. Just register. Do me a favor, just register, because if you don't register, I don't know how much food to order in advance. So that is always a problem. So that's the only request I have. Share it with friends, family members. And I'm going to talk about some of the great companies that I'm looking forward to in 2026. I'll talk about some of the real estate markets, and I will obviously talk about how to solve the tax problem. So some of you guys are really good at stocks. You make a lot of money, but you don't end up selling them. Don't book the profit because you're afraid to give that away in taxes. We'll talk about solving that problem. Real estate, high W-2 income. Maybe you are a business owner that is just not having a good tax professional on your side. Well, this is your opportunity to come see me in person, spend 6 hours together, learn more about finance, learn more about investing, learn more about taxes. Now, before I begin, let me remind you guys, I'm not an investment advisor, so I'm not here to tell you to buy this hedge fund, this ETF, or this stock. None of my business. Pure educational in nature. But I can promise you this, that you're going to get a lot of value. Don't trust me? Talk to my community. We have 700 plus people on WhatsApp. I think every single one of them will be happy to vouch. Take a look at some of the other events that I have done. And, most importantly, even if you don't trust me, come anyways, spend 6 hours and then decide for yourself. What's the worst can happen, right? I'm not charging you any fees anyways. All right. So let's talk about this company. So this company is FICO. In 1956, Bill Fair, an engineer, and Earl Isaac, a mathematician, both working at the Stanford Research Institute in California, noticed something troubling. Loan officers made lending decisions based on gut feeling, kind of like what we do with stocks. Personal bias, again, like the way we do with stocks, and subjective judgment. We see that all the time in our WhatsApp group, even today. The same borrower could be approved at one bank and rejected at another, purely based on which loan officer happened to review the file. Fair and Isaac believed mathematics could do better. With about $400 investment and a borrowed computer, they founded a new company, Fair, Isaac and Company, in a small studio apartment in San Rafael, California, 1956. Their first product was a credit scoring system for Montgomery Ward department store in 1963. Many of you guys probably had one of those department credit cards from Montgomery. It was a very popular store, I think. I want to say back in 1990s, maybe till around 2000. And I think after that, it kind of just disappeared. In 1989, they launched the first general purpose FICO score in partnership with 3 major credit bureaus. The real inflection came in 1995 when Fannie Mac and Freddie Mac mandated FICO scores for every mortgage they backed, embedding FICO into the foundation of American homeownership. Today, the FICO score is consulted over 10 billion times a year. In 2009, the company officially rebranded from Fair Isaac Corporation to FICO. Very simple, right? So great, interesting start of a company. I always like to share the beginning because it just tells you how humble these people are, no matter what happened with their companies. And the second reason I do this is many of you guys are waiting to start a business. Many of you guys are waiting to start a company. And we think maybe the financing is our problem, the timing is our problem, not finding the right business is our problem. But by sharing these beginnings of these companies, kind of give you ideas as to how they got started. I mean, take a look at FICO. Started with $400 and built a multi-billion-dollar empire over the last 70 years. All right, let's talk more about this company. What is FICO? Well, it's a three-digit number that controls access to American credit. In matter of fact, if you think about it, that three-digit score can determine how are you going to do financially in this country. Can you imagine what kind of power that score actually has? At the simplest, FICO makes the credit score. When you apply for a mortgage, car loan, credit card, any form of borrowing in the United States, the lender almost certainly checks your FICO score, a number between 300 and 800 or 850 that summarize your credit worthiness at any given time. The higher the number, the lower the risk you pose to a lender. FICO scores are pulled approximately 10 billion times per year in the United States. Over 90% of top US lenders use FICO scores. When you get a mortgage, a FICO score is pulled from each of the three credit bureaus, Equifax, Experian, and TransUnion, and the middle score is often used. Until recently, FICO score were mandatory for mortgages backed by Fannie Mac and Freddie Mac. In matter of fact, that was the major push why the company became this big. The government-sponsored entities that buy and guarantee the majority of U.S. mortgages, this mandate made FICO effectively unavoidable in the $12 trillion U.S. mortgage market. This is now changing. So that's why I'm a little bit worried about this company. I'm a little bit worried about the business model. Now, I do have clients who work for this company. So if you are one of those watching, my apologies. But I think most likely I'm going to be helpful. And if I'm wrong, by the way, about any of this stuff, which I hope I am, please do comment in the video. Tell me why you disagree. So that way I can build a better thesis. So FICO has two business segments. The scoring is roughly about 69% of their business. The credit scoring business is split into two subsegments, B2B and B2C. The FICO charges banks, mortgage companies, auto lenders a fees every time they pull a FICO score. This fees varies by the loan type. Mortgage origination scores now cost approximately $10 per pull, raised from $3.50 in 2024. In my opinion, I think this was a big mistake because when you do that, when you start taking advantage of your customers, when you raise the price from $3.50 to $10, your customers are going to find, or somebody else, a new innovator, somebody who sees the world a little bit differently than you, they are going to find a way to build a better product at a lower cost. And that is exactly what FICO is going to deal with right now. FICO certainly had a pricing power. This pricing power has been the primary driver of FICO's extraordinary profit growth over the years, primarily caused by regulatory and competitive backlash. I mean, they literally had the government backing them up. Then we have B2C business segment, right? Business to consumer scores. FICO sells credit scores and monitoring directly to consumers through myfico.com and partnership with a lot of different monitoring services. This is a smaller, more stable revenue stream. Then they also have software segment of their business. 31% of their revenue in 2026 in quarter one came from software, analytics software, and decision-making platform sold to banks, insurance companies, telcos, and retailers. Product includes fraud detection software, Falcon, used by most major credit card companies to detect fraudulent transactions, loan origination software, debt collection optimization, insurance decision-making softwares, and the FICO platform, a cloud-based SaaS platform for enterprise-wide AI-powered decision-making. The FICO platform is the future growth engine. It has a software dollar-based net retention rate of 109% in Q2 of 2026, meaning existing platform customers are spending 9% more per year on average. Platform annual recurring revenue grew almost 17% year over year. So I'm actually more excited about this business segment than some of their other business segments. Now, let's talk about why this company is exceptional and then what is the problem. So, B2B mortgage score revenue grew almost 127%. I mean, think about it. Why would I be bearish on a company that grew their revenue by 127%? I mean, if anything, I should be more bullish on that company. The price increase on mortgages origination score from $3.50 to $4.95 in 2024 was a steep increase. But then they went to $10 in 2025. This is driving great growth. Now, you may compare this to Micron, another one of my favorite companies that I have owned since it was about $100. Now it's touching almost 650 today. And I wouldn't be surprised if it doubles, even triples from here. Okay. Not in a straight line. It's going to have pullbacks. It's going to have some problems. But my thesis is on memory stocks is that more memory will drive more innovation, more technology, more people going to build products. We haven't even seen robotics yet. We haven't seen edge AI yet. We haven't seen something happening with personal computers yet. We haven't really even seen how AI really going to solve practical problems in hospitals, in retail stores, in driving. I can't even imagine what our cars going to look like in 10 years. All of these innovations are going to require a lot of memory. That's why I'm more bullish on that. By the way, if you're curious, go check out the other video on Micron. I did that a few weeks ago, and I think stock has gone up a lot since then. So, but still, I think there's a lot of possibilities in future as well. Am I buying Micron right now? No, because I have an extensively large position already. But if there's a pullback, I'm certainly a customer there. All right. Now, if you don't own any, then you got to start somewhere. So keep an eye out on it. All right, free cash flows. I love cash flows. That's one of the favorite metric for me to pick a company. Well, free cash flow are $250 million, surged 227% year over year from 65 million to 214 million in 1 year. This is a cash generation engine that funds buyback. Largest ever quarterly share repurchase was done for about $605 million at 1,090 per share, retiring approximately 550,000 shares in single quarter. With 24 million shares outstanding, this is 2.3% of company bought back in 90 days. This is incredible. You see, the reason I'm telling you all this is every single one of those are the reasons why I need to be bullish on this company. So unless you look at the negative sides, this can sidetrack you. It is. That's one of the metrics we kind of all rely on, whether we want to invest in this company over the next year or two or not. For 2026, revenue is guided to $2.45 billion, non-GAAP EPS to about $40. Management explicitly stated no expected volume loss is going to happen due to a new competitor known as Vantage Score in 2026. Right? It's not like they didn't really say that, oh, it's not going to happen in 27, 28. They said, look, it's not going to happen in 2026. We'll deal with 2027 later on. Platform software NRR of 109%. That means the net retention is great. That makes sense because there is no other competitor. Where else somebody going to go? That's the whole problem with this business to begin with, because they have so much pricing power. They are able to literally abuse their customers left and right because the customer has no choice. That is the problem. Like you cannot go from $3.50 to $10. It's not like all of a sudden there's a huge demand for it. Like it's not like a memory. It's not like industry is growing. It's the same people. Nothing. I mean, take a look at the home building industry. It's dead, right? Nobody has made any money, but this company continued to increase their price. I think many people will probably call it an abuse. Okay, from a company point of view, hey, we're the only one in the business, so why not? Sometimes I see that even in small businesses. For example, there's a business owner who wants to sell his business, somebody else wants to buy it, but because they are the only one in market, they will ask for ridiculous pricing. And that creates a problem. Like you have to be reasonable in whatever you do, even if you have some sort of edge. Okay. Otherwise, you're going to make people hate you. You're going to make people uncomfortable working with you. And that is going to work against you over a longer period of time. All right. Why am I bearish on this company? Let's talk about that. Software segment is growing only 7%. The strategic future of FICO depends on platform software. If I was the CEO of FICO, I would be thinking about how to bring the prices down, because with the AI, that competitive mode is not going to exist. This is going to become a commodity in few years. Instead of increasing the prices, I should be thinking about, how do I bring the price down? How do I keep my customers happy? How do I eliminate a need for new product? That's what my focus should be. And how are you going to do that? You're going to do that by focusing more on AI and new innovative technology. This company's software segment is only growing at 7%. So that tells me company focus is not on the right area. Number two, non-platform software, ARR, annual recurring revenue, declining. Older legacy software products are losing customers, although the new platform is growing. Once again, they're not able to keep their customers happy. Mortgage origination is a big dependent kind of a business, right? They have 127% growth in B2B mortgage scores, is mostly driven by higher prices. If they would not if they would not increase their prices or double their prices, they would not have the growth at all. In matter of fact, the business would be negative. And then on top of that, you see, the even though the markets are down in real estate, but the mortgages are still high. They're not selling for that cheap. So because the prices are only going higher, obviously they're able to make more money as well. But there's a risk. If interest rates rise, origination falls, the revenue is going to hit hard, and company can take a big hit. Negative shareholder equity. Now, if you have never heard of that term before, that's a good thing. We love negative shareholder equity. That's right. It had the word negative, but it's still a wonderful thing. For FICO, that number stands at 1.8 billion. That means FICO has bought back so many shares that the equity on the balance sheet is now negative. Company has more accumulated buybacks than total equity value. This is legally fine. There's nothing wrong with it, but it makes traditional, comparison metric like price to book ratio, which a lot of people use when they're buying stocks, is meaningless, right? At some point, that is, yeah, you have a lot of cash right now, but what's going to happen a couple of years from now? Vantage score is the big competition for them, and that is going to add a lot of pressure. Now, the company is saying, don't worry about it. But that is exactly when I get worried. This is what the CEO of the company said on their 2026 earnings call. We continue to deliver strong revenue and earnings growth. I agree, mostly because they charge more. We are pleased to announce that we're raising our full year guidance. That means they are expecting what? Are they going to continue to increase the price? That kind of worries me a lot. Or are they bullish on the mortgage industry? Well, so far, things are not looking there. What does he know that rest of us doesn't know, right? So maybe the whole market got it wrong. Maybe President Trump already told him, you can count on interest rate cuts. They are coming soon. But if you take a look, people are actually talking about rising of interest rate, not interest rate cuts. So that kind of bothers me a little bit there. Let's talk about Vantage Score, because that is my core thesis here, why I'm bearish on this company. Vantage Score is why, I want to talk about Vantage Score, why it is a threat, and why the stock fell 50% from 2025 high. And obviously, company went on buying spree to buy all those stocks. So Vantage Score is a credit scoring model created as a joint venture between the three major credit bureaus. I mean, remember, these three are the three main customers of FICO. So when you abuse your customers, what do customers do? They become innovative. They find some other solution. They find a cheaper way of doing business. Equifax, Experian, TransUnion. It produces a credit score between 300 and 850, very similar to FICO, identical range, right? And claims to use more modern machine learning techniques and alternative data like rental payment history to score consumers who are credit invisible under traditional FICO models. So these credit bureaus are saying, hey, look, I think we have found a better way, a better technology that can account for other things that FICO doesn't even account for. So that means we can access to more borrowers. We can give loans to more people. That is what the government wants. That is what people want, and certainly is cheaper as well. Vantage Score is nothing new. They have existed since 2006, but was never a serious FICO competitor because Fannie Mac and Freddie Mac, like I said, two big regulatory bodies who back majority of US mortgages, required FICO scores exclusively. Without mortgage market access, Vantage Score was largely irrelevant to the highest value use case. But things change between 2022 and 2025. And that's why, by the way, on a side topic, that's why I'm slightly still bullish on crypto, especially Ethereum, because of what's happening with the regulatory framework these days. That's why you're seeing Coinbase going up, Hood going up. You're seeing, a lot of excitement building up in the crypto community once again. So keep an eye out on that. Regulatory framework could make a lot of difference. The Federal Housing Finance Agency, FHFA, the regulator of Fannie Mac and Freddie Mac, decided to end FICO's mortgage monopoly. After years of regulatory proceedings, the FH implemented a lender choice model allowing lender to use either FICO 10T or Vantage Score 4.0 for Fannie Mac and Freddie Mac back mortgages. This is the first time in 30 years the FICO lost its mandated status in mortgage lending. This is a big deal, even though company is underplaying. Now, the Bureau's price war is the most aggressive competitive threat to FICO. Equifax, Experience, TransUnions, who own Vantage Score, begin offering Vantage Score 4.0 mortgage origination scores at approximately $1, sometimes $1.50, so between $1 and $1.50 per pull, directly competing with FICO's $10 price. I mean, how is FICO going to survive? So when you can get the same product for $1, and you don't get who gets to decide whether they use the $1 or $10, the $10 guy's customer. He is the decision maker. And who owns that $1 company? Their customer. No brainer. FICO is way underestimating the threat. They're trying to milk as much as they can, and they're, trying to basically buy back their shares. So even if they lose the market share, then their earning per share hopefully will be reasonable. That is their strategy. That's where the focus is. So that's why I'm actually bearish on this company. So like I said, this price difference is anywhere between 10 times to 7 times. Bureaus weaponizing their control over raw credit data against FICO, essentially subsidizing their own competing product using data profits to undercut FICO fees. On March 12, 2026, and this dynamic became full clear to the market, FICO stock fell 9% in a single day as UBS cut its target from 1500 to 1350. Now, why FICO's management says the threat is overblown? Let's talk about that as well, because unless we understand their point of view, we're not going to be able to arrive at a proper thesis. And I apologize for making this a little bit of a longer video, but I think it deserves it because we need to look at this from both angles. Not doing a good job, or if I'm like overextending it, please do leave it in the comments. My humble request, whatever you want to say, please say it in comments. I want to engage with you. I want to hear from you. All right. So why does the management say that, don't worry about it? Well, Q2 of 2026 guidance explicitly stated no expected volume loss to Vantage Score in 2026. Management sees no actual switching happening yet despite the price differences. Switching from FICO to Vantage Score requires lenders to revalidate all their internal risk models, a process that takes 12 to 24 months, and it can cost millions of dollars. So they're right. Lenders are deeply risk averse, using an unvalidated score that might fail to predict default would be catastrophic for these banks. I agree. Vantage Score mortgage origination scores revenue at the Bureau grew 60% in 2026. But this is mostly because of FICO raising its own prices, not because Vantage Score took their share. The volume is still flowing to FICO, only the price is different. FICO's direct lending licensing program, launched to sell scores directly to lenders, bypassing bureaus, reduces dependency on bureaus' distribution and undercut the bureau's pricing war strategy. So, basically, FICO is saying, hey, look, you are now becoming our competitor. And because you're our competitor, maybe we should find another way to sell our services. So instead of going to you, we are going to go directly to the banks and sell our services to them. So that way they don't have to depend on you, and maybe they can give a little bit better pricing. But like I said, pricing is the core of this thing. And I haven't really heard anything from FICO about making a compromise on pricing. I think that is the one big problem for them. But I do agree with them. It's not going to, the effect not going to be immediate. But why would bank want to pay $10 if Vantage Score can offer them a competitive product? That is the key question here. Then comes Department of Justice investigation. That's right. The Department of Justice has opened an antitrust investigation into FICO's pricing practices, especially the aggressive price increases on mortgage origination fees from $1 to $10 in 5 years. FICO's management have not commented publicly on specifics. Adverse DOJ finding could force FICO to roll back prices increases, directly attacking the primary driver of recent profit growth. So let's say if they have to go back from $10 to $5, what do you think will happen to the stock? This is the biggest binary risk in FICO thesis. If DOJ forces price rollbacks, earning per share can fall between 30 to 50%. And once again, FICO is somehow preparing for it by buying back those stocks. So if they're able to buy half of their stocks, then even if that results come not in their favor, they will still be okay. So if you ask me, this Department of Justice investigation, I think, is a big risk. The revenue growth is really only coming from price increases. Stock is still quite expensive. Shareholder equity is negative, software growth is only 7%, and then eventually lender choice. That means the customer get to choose who do they want to work with. They have lost the biggest moat they actually have. So the bottom line is this: current extraordinary profitability is built almost entirely on price increases that have drawn government antitrust scrutiny and ignited a competitive response from three of the most powerful data companies in the world: Equifax, Experian, and TransUnion. The business itself, a genuinely powerful network effect, billions of scores pools annually, deep lender integration is excellent. I love the company. Nothing wrong with that. But I think what got you here won't get you there. You probably have read the book. I think that is the problem. This company needs somebody who can say, it's not about how much money you make. It's also about whether your customers love you or not. And you have lost the trust of your customers. You have lost the faith of your customers. You cannot continue to go on and abusing them. That is the message the CEO of the company needs to hear from someone he trusts. I'm sure that's not me. Now, the profit engine of the company depends on maintaining $10 per pull mortgage pricing that was $1 per pull 5 years ago. The central question is not whether FICO is a good business. It clearly is. I can vouch for it. The question is whether the Department of Justice allows the current pricing to stand and whether lenders eventually switch to Vantage Score as the model risk concerns diminishes. Both of these are unknown today, which is why the stock has fallen almost 50% while the business posts record earning. So you cannot always buy a business because they are doing great. You do need to do some fundamental analysis to understand the business, whether you want to be in it or not. Now, I could be wrong. FICO can turn around. FICO can reduce price. FICO can, work with lenders. FICO can, and maybe the Vantage Score itself disappears because it's just not that good. If you take a look at the analyst, Wells Fargo have the price at $2,400. Various other analysts, almost 20 analysts, are putting the price at $1,975. Market beat estimate, I'm looking at it about $1,700. So you can see a lot of people are bullish on this company. So I can't be the only one who is looking at it the way I'm looking at it. But I'm quite surprised that these analysts get paid millions of dollars for making their analysis, and that's the price tag they have put on FICO. Once again, guys, I love FICO. I love the business. I love what they have done. I love their contribution to this industry. I don't like them increasing their prices by so much in such a little time. I don't like that they have the monopoly, and I certainly don't like that they are not addressing the core problem of their business. So those are things I don't like it, and that is why I'm bearish on this company. So I hope you found some good value out of this analysis. And if you do, then please take a 2 cents and write a comment. That is all I need from you guys. If I can help you out, become part of my WhatsApp community. Come see me in person. Like I said, I'm going to be in Austin, Texas, Round Rock, downtown. We have a beautiful venue, Central, and we're going to be there from 9 a.m. to 3 p.m. And we'll have breakfast together. We'll have lunch together. We'll talk about all kind of things. But again, I'm not an investment advisor, so I can't tell you what to buy, what not to buy. I can just share my thesis and how I think about companies. That is all I do. Thank you so much, guys, and I'll see you next time.